All right. Okay. Hi, everybody. This is Z coming to you from NoVa Notes and Awana Holdings. And I have my guest here today, Mr. Fuquan Bilal. And you know the drill. So what we're going to do first is go through, my introductions and tell everybody a little bit about myself. And of course, our disclosures that I normally go through. So let me get on with that. Okay, so of course the disclaimer, I am not offering any financial products here. I'm not an attorney. I don't pretend to be an attorney. Some of my guests may be attorneys, but they're not your attorney. So you seek out those professionals if you desire those services. So a little bit about myself for those of you who don't know, or if it's your first time joining me. My name is NNG. People affectionately call me Z because it's a lot easier to say. I'm a retired Navy veteran, and I'm currently a federal contracting officer by day. I have a master's in education and a master's in public administration. Been real estate investing informally for a little over 30 years, just doing the typical fix and flip. And then I bumped into something called mortgage note investing, and I started my business in 2018, and here I am doing mortgage note investing. So I'm trying to bring you guys some guests here, put people in front of you who look like the community and are doing some things in the space of mortgage note investing. So here are some ways for you to get in contact with me if you should so desire. And I'm going to go pretty quickly so I don't take up too much of Mr. Bilal's time. So I typically go over what a mortgage note is, basically, for those of you who may not have an understanding of how mortgage note investing works. So just very simply, it's a little different from let's say if you were a mortgage note, or a typical real estate investor who maybe does fix and flips where you buy the property and you actually own the property. Mortgage note investing is a little bit different in that you're the lien lord, if you will. You own the loan. So you don't own the property unless and until you end up perhaps foreclosing on the property. But we say that you own the paper. So you're the bank. And with that, that's actually a pretty good segue to introduce my guest, Mr. Fuquan Bilal. He is the CEO of NNG Capital Fund. And while they, I believe, invest in notes, I'll let Fuquan tell you about that. They are not I don't think, a typical bank. So they have a fund that other investors invest out of. But I'll let Mr. Bilal tell us about that. Fuquan, thank you so much for joining me. I appreciate it. And
yeah, thanks for having me
tell
on
us
the
about
show.
yourself.
Thanks for having me on the show. I really appreciate it. Can you hear me?
I hear you fine.
Awesome. Excuse the background noise. I'm actually enjoying this beautiful weather outside. I'm in Plano, Texas at one of my masterminds that I attend. But yeah, I got into the note space in 2011. And just like yourself, I've been doing real estate now for about 21 years to date, started in 99. Mm-hmm. And I learned the note business by accident. I was negotiating a short sale and the negotiator had just said, hey, why don't you just buy the note? And I'm like, how do you do that? So it explained the process of assigning the debt over to me and the instruments that were included with that. I was very intrigued and started to go down the path of discovery. Got into the business, invested my own capital in about 2012. Got really great results from it in a short period of time. It was all laptop cell phone, and I was in love with it from then. I didn't have to deal with tenants tall as trash and termites or contractors.
Right.
So I began to laser focus on this industry. I saw that out a mentor. So
but before you did that, Fuquan, were you like a realtor or something like that in real estate space?
No, I actually didn't give my real estate license in 2010. I started off in 99, and 11 years later, I got my real estate license. But I started off as a fix and flipper.
Okay.
So all the way from 99 until the market crashed, I just flipped properties. I wasn't a landlord. I didn't really want to play in that space. I would buy them, fix them, and sell them. And when the market crashed, I was forced to be a landlord because I got stuck with a lot of properties and the banks were not refinancing and doing anything. And I really hated that business because I wasn't doing it. I didn't understand it. I didn't have processes and systems in place in order to, do it correctly. I remember driving around with my kids in the back seat, knocking on doors, collecting rent. And I was like, this is not what I want to do. So I quickly learned something else that was a little bit more passive, which was short sales with that cash injection of just flipping properties that way, wholesaling to other investors. And then I discovered the note business during that time.
Okay.
Like I said, I seeked out a mentor and leveled up in the business, laser focused on it. In 2013, I launched a fund to be able to raise capital to be able to buy the notes at a bigger discount.
So wait, now,
today,
hold on, because you're jumping over some steps. You're jumping over some steps. So when you found the world of note investing, did you just invest in notes, like you said, with your own capital, of course? But you didn't just jump from doing your rentals and fix and flips straight into a note fund, did you?
well, at the time, the market was really slow. It wasn't much happening around that time. It was just starting to pick up. Short sales was still the major thing to do in a space. You lock a deal up on a short sale and you sell it to an investor. I did probably 3 to 5 flips a year. I didn't really, before that I was doing 30, 40 a year. So I really, scaled down and started focusing more on investing in paper because as I mentioned, it was pretty much laptop cell phone where I can, from my conference room table, negotiate deals and help homeowners stay in the house and structure discounted payoffs. So it just changed to my investment strategy. And I began, as I was more intrigued with the space, to just focus on that. Now I'm all about diversity. So yes, I did do a couple of flips, but going from 30, 40 a year down to 3 to 5 a year is a major difference where a lot of my time is not spent doing that. So just laser focus on notes. Wow. That's what I focused on. And like I said, in 2013, I launched the fund.
The fund. So in the fund, tell us a little bit about what a fund is and what it actually does for those of us. So it's going to be, I guess, a little bit different, maybe geared more towards the passive note investor.
Yeah, so it was basically a vehicle that was set up to help investors, ride my coattail, if you will. A lot of the investors, when I first got involved in 2012, they didn't understand it. They did not want to invest alongside of me. These were some of the same investors who invested.
But they do now, huh?
Yeah, of course. Yeah, for sure. Because I built a track record and have historical returns, and all that stuff take time. But in the very beginning, it was tough. It was just friends and family because it wasn't something that was tangible that if I defaulted on a payment, they can go and take it back from me. Right. They didn't understand the space. It was unorthodox. So no one wanted to touch it with a 10-foot pole, as they say. So I had to invest my own capital and build the case studies to kind of show them how it works. And after doing that for a year and making about 40% return on my money, I was able to show them 4 case studies where I actually went out, deployed some capital. These were the results, whether it was a discounted payoff solution, whether it was a workout solution from taking a non-performer to a performer, whether it was a short sale solution. I was able to show different case studies of the results what happened from the investment I made.
Right.
And then I created the first vehicle where friends and family, people who knew, like, and trusted me, really invested in me because they know that I will be responsible with the capital, and they invested in me primarily. Then that allowed me to build a bigger track record by buying more notes because I was raising more capital to buy on a bigger scale at a bigger discount.
And you had started your fund at this point, or were you still just kind of raising capital with your friends and family to buy just notes?
Well, the first round was me putting my own capital in 2012. And then once I built those case studies, I began to raise capital through a fund, because if you raise capital from more than 1 or 2 people, then you want to set up a vehicle where you're not validating any SEC requirements, pooling money together and stuff like that. So that vehicle allowed me to do that safely. And I was able to bring friends and family on board. It was a small fund for about $2 million. We raised that within a couple of years. And then the notes that we purchased through that, now we were able to create more case studies, and we were able to build history, transactions that happened? What happened when those notes? What was the evolution of this pool? What happened? What were some of the things that we learned? What were some of the processes that we built? So it was pretty much a learning curve in the beginning. So that fund quickly wrapped up within 3 years, and then we're on our fourth fund now. And today our model is more diverse, and we still buy notes, but we also invest in tax liens and we invest in real estate as well, all in the same vehicle. And this way, wherever the opportunity is that's profitable, we can deploy capital.
Yeah,
But I love the note space. It's
I
one of the
see a
best
lot of
investments.
your I see a lot of your beautiful flips that you do, and I was going to ask you, do you I guess fund those flips out of your fund, or is that
Yes, we
like
do.
separate transactions?
Yes, we do. Yes, we do. So what I started to notice in 2015 was the real estate market started taking off again. And at the time, I wasn't doing as many flips as I do now. And I had connections with direct bank connections that I still have today that I was buying notes from. And they will always put a lot of REOs in New Jersey, where I live at, and been invested in the last 21 years, in my face and go, hey, you know, would you be willing to buy these? And no one wants to buy New York and New Jersey properties because they're judicial, and it takes a long time with the foreclosure process. So I was able to capture some of that stuff through my direct bank connections or other hedge funds that I knew that were selling these REOs, and begin to increase my flips. And then it kind of changed because at that time in 2015, real estate prices were low and note prices were high because everybody was getting into the note space. So I saw trades where we were getting stuff from when I first got in at 10 cents on a dollar. The things were now trading for double the amount. Everyone wanted to invest in notes. There's so many educators out there, so everybody's new people are coming in, overpaying, not knowing how to evaluate tapes, and that kind of drove the market price. It became the seller's market in the note space. So what I decided to do was to just pivot a little bit and focus on real estate, start deploying more capital there while we still look for trades that made sense in the note business.
Mm-hmm. So in your note fund, do you focus on a particular note, meaning first position, second position only, performers, non-performers, or do you just do all of them?
Yeah, so we do anything that's under 100,000 unpaid balance, whether it's a first or a second. Predominantly seconds. That's the space that I love the seconds. I came in the second mortgage space, and you can get a bigger discount. It's more diverse. You can kind of leverage risk by doing that. But we purchase everything from 100,000 UPB or less. That can be a first mortgage in Florida somewhere, or Ohio somewhere, or Atlanta. But most of the tapes that we buy are HELOCs, whether they're second mortgages or they were purchase money mortgages that were given in second position. Mm-hmm. So those are the type of assets we buy. We do buy performers and non-performers. I prefer non-performers because we can get a bigger discount. When we buy performers, we usually try to buy them where we can get a big enough discount to create a situation where it makes sense.
Right, right. And so people who do invest in your fund, are they given a, what do you call it, a target return, or does it just depend on the investment?
Yeah, so our fund is for accredited investors only. They need to have a net worth of $1 million or generate $250,000 a year personally or $300,000 jointly. So that's the avatar, and the investment that they make in the fund, it's a 10% return. There's no profit participation. Right. So they get a 10% return. The term is 3 years for Class B, and we have a shorter term, which is a Class C for 1 year. So, and they get the compounding interest. We have a compounding feature where if they don't take the distribution and they compound the interest on the interest, they can earn up to 11.5%. Okay. So we do have that, but it's for accredited investors. We try to target that. My first fund that I opened up, like I said, it was friends and family. It was non-accredited, and it became more of managing people instead of managing money. When you have a less sophisticated investor, they tend to, if they have 50,000 in the bank, they want to deploy 30,000. That's their life savings. They want to call you every week, every month. You got to do a lot of hand holding. And for the first fund, friends and family is okay, but once you build that track record, you should target accredited investors who understand the investment type. If if they lose 50,000 or 100,000, they get it. They understand that it's the investment and the risk that's involved with it.
Correct.
Most non-accredited investors, can't stand to take that loss.
Right.
So, if you're doing friends and family investment, they really have to understand the risk that's involved. Any real estate investment have risk, so they definitely want to, be aware of that.
Right. So I
And I
have a
saw the
question.
questions of 506C.
Yeah, I have a question from one of my viewers, and he's asking what type of funds rule 506B or 506C or other? How many years are the note funds exit? And what's the minimum investment?
Yeah, so it's a 506C, accredited investors only. And it's a 3-year term on Class B, and Class C is a 1-year term.
Mm.
So, you have some funds are set up for, again, non-accredited investors. Like if you are looking to open up a fund and you don't have a network of accredited investors, then definitely you want to set up something where you can have non-accredited investors and just invest with friends and family. But you can't come on a forum like this and openly talk about it.
Right.
That's the only caveat. That's the only drawback from it.
And that's
But,
the 506B or the C?
Yeah, it would be. So if you're doing flips already and you have some investors that you've been doing business with for years, those are the people who you want to start to communicate with, especially if it's going to be more than 2 people. If you're doing anything with more than 2 people, then you definitely want to set a vehicle if that makes sense, unless they're actively involved. So if you're doing a joint venture and it's 5 people, like a lot of note buyers, what they tend to do if there's a trade out, and they all have, let's say, 100,000 each, they're going to pool their 500,000 together, but they're all going to be actively involved in a trade. They're going to do due diligence. Somebody might manage the servicer, somebody might manage the asset manager, somebody might manage the document custodian, and they're all reporting to each other. They're actively involved. No one is passive. So you can set something up like that, where there's a true JV, and basically you can avoid setting up the cost for setting up a fund.
Okay. So what is the minimum investment in your particular fund, if there is a minimum?
Our Class B is 10,000 and our Class C is 50,000. The shorter term is a higher hurdle. So it's 50,000 minimum investment. That only pays 8%. If you compound it, it's 9.4% or something like that. And Class B is 10%. It's 3 years. And it's $10,000 minimum investment in that. Our average investor is about 100,000.
Right.
The reason we set the investment so low is because people get a chance to redeploy the interest that they earn.
Mm-hmm. Okay. So how many investors are allowed in each fund? Is there a minimum or a maximum, I guess, that are allowed for each fund?
Yeah, so when you have a non-accredited fund, you only allowed up to a certain amount of non-accredited investors and accredited investors. When you have an accredited fund, it's pretty much limited to the amount you raise. So what you want to look at is how long is the funded term going to be? And what we usually do is when we get 85% of the capital raised, like this fund we have is a $15 million fund. It's a small fund. And when we raise 85% of it, we will start to look to open up a new fund. But what I would highly suggest is just consult with an SEC attorney. A lot of them will give you an hour if you're looking to set one up. This is the mistake a lot of people make when they're looking to set up a vehicle to create for investors to invest in. They try to look for boiler templates online, right? So they can copy and paste and do it. And then they'll give it to an attorney thinking that they'll save half the money because they already have a template and they're only going to pay an attorney for a certain amount of hours, right? That's mistake number 1. Mistake number 2 that I see people make is they reach out to companies who promise that they can create the PPM and help them raise money, right? There's probably a handful of companies that can actually do that have a track record in doing that. So you want to be mindful when you're looking at stuff like that. The best way for me, which has helped me, because I looked at those scenarios. That's why I'm telling you. I was like, I don't want to spend $30,000 to set this up. I could just copy a template. I can just reach out to a company. I've looked for shortcuts before I got started.
Right.
And the best decision I believe I made was consulting with an SEC attorney. So all the questions that you want to ask me on this, you can actually direct those to the SEC attorney. They can give you information on legal information, because I'm not going to give any legal advice here.
Right,
But
absolutely.
you can consult that person. They'll generally give you an hour for free, and you just ask them all your questions. You know which direction you want to go. The biggest expense in setting up a fund is the operating agreement and the business plan. If you have that together, your process, what are you going to go through? How are you going to mitigate risk? And you have all that in writing and you give it to the SEC attorney, they will develop the operating agreement, and then you can go from there. That's the biggest part. Most SEC attorneys will range from 400 to 550 an hour, and most of the time will be spent developing an operating agreement.
Okay.
So once you have that done, then the next fund that you set up is just a boiler template of the first one you set up. You just have to probably change the officers, the strategy, investment criteria, and stuff like that. But it's an interesting concept. I mean, it's anyone who has experience in real estate, I definitely would tell them to look into doing that instead of, it's the biggest challenge for me. And the reason I brought real estate into my fund instead of just notes was I would borrow money from people who had IRA accounts. Because I had a lot of people that were not accredited that would reach out and say, hey, I have 50,000, I have 25,000, how can I invest with you? And those are the people that would do, trust deed investing. They would be a lender on a property or a second lien holder for a construction loan. And for me, the biggest risk is putting a deal under contract and someone telling you they're going to invest with you. And then when it gets time closer to the closing, they change their mind because a family member says, oh, you don't want to do that. That's risky. So you have no control when you depend on individual investors to do trust deed investing. And you have more control when you have a vehicle where you can pool the money and then you can deploy in assets that's within your business plan.
Right. And so that was another question I was going to ask you. So are any or all of the investors that are investing in your fund, are they investing with their cash, or are they investing out of retirement accounts like IRAs, self-directed IRAs and things like that?
Yeah, some are both. Some are both cash. Everyone, if you have an IRA account, definitely try to invest, from your IRA account or your family trust account, if you have an insurance set up where you're borrowing against the policy and investing, borrowing money at 3% or 5% and arbitraging that 10. Those are some strategies that you do. We have some people who borrow from their 401k and arbitrage. We have some people who get lines of credit against their house. Now that money is cheap, and they invest it in the fund and they arbitrage. They play the same role as the central banker. They borrow money now at 4% and they put it in a fund at 10%, and they just collect money and pay off their credit line back. So they make money that way as well. So there's a lot of different types of investors that we have in the fund.
That's good. That's good. So, okay, so you went over, and thank you for that, the steps that an investor would take if they're trying to set up a business. And we talked about those who maybe wanted to invest passively, how they would do that, either out of their IRA or, via some kind of a cash investment. And I think that was it. If anybody else has any questions out there, you should be able to unmute yourself and ask. You should be able to unmute yourself, Aldo.
Hi, Z.
There you go. Right.
How you doing?
Hi.
I have a question, actually. Yeah, so far it's really good information. Thank you very much. The question is, looks like you have a nice place where you are right now in the park.
Oh yeah, I'm in Plano, Texas. Yeah, it's kind of windy out, but it's beautiful. The weather is nice.
Yeah, it looks like a nice place to sit and have a Zoom meeting. So the question is that the funds that you have, do they, like for investors, do you have like a fund management fee? Are there fees to be paid from the investors? And if so,
yeah,
is this part of the yield, or is that minus the yield of the fund?
Yeah, so the way the fund is set up, and again, if you guys are looking to set up a fund, a lot of fund managers set things up differently. So you have apartment syndications where they usually get acquisition fees up front and things of that sort. And that's how most fund managers actually generate income, if they have the management fee, right? Because when they set up this fund, originally they're going to do all of the marketing. They're going to put out all this money up front to set up the PPM. They haven't raised money yet. So, where does the money come from to consult with the SEC attorney, to set up the LLC, to get the PPM going? You spend $20,000, $30,000 doing that, and you haven't raised a dollar. So usually to get that money back, most fund managers would charge a management fee. and it's only right for them to be compensated back to run operations. And the management fee may pay for payroll expenses, office expenses, and everything else, just to do the day-to-day operations. So that's what those fees that most fund managers have is charged for. When you're looking at a PPM, you want to be mindful of the fees, and you want to make sure that the fees are in alignment with what they're doing. It's not just I'm getting paid a fee because I raise capital. You know, you want to make sure that your investors get paid before you do. So to answer your question directly, for our fund specific, yes, we have a guaranteed payment that we are entitled to, which is 5% of the capital we raise. Just to give you a case in point, our fund is $15 million. We launched in December 2019. We raised probably $7.5 million since then. We had a slow start because of COVID, Q1 of 2020, but we raised about $7.5 million to date of that. And I think for a guaranteed payment, I've mainly taken maybe $50,000, and I'm entitled to 5% of the $7.5 million. So just to put that into perspective, I've made distributions to my investors in over a year, and my investors are getting paid more than I am, right? So that's the structure that I do. I mean, I have the right to pull that guarantee payment out at any time, but I like to keep liquidity in the fund. Basically, we have about 10 million in assets to date, and we raised about 7.5 million. So we have about a $2.5 million cushion. So that's how I operate my fund personally. Most fund managers, they will take an acquisition fee on a purchase of a property or something. And again, they will use that money to take money back that they actually put out in due diligence and everything else. So that's pretty much how those fees are set up. Hope I answered your question.
You did. Thank you very much. And I think that's a very good business model, the way you have it set up. You know, you want to keep the investors happy. I mean,
yeah, I mean, that's what I've learned along this journey. That's the first thing investors look at is what are you getting out of it? Are you getting paid before me? How are you getting paid before profits? Do I get my K1s on time? How was the communication? So through my learning experience for my first fund, these were some of the things that I've learned, which were investors concerned that I said, okay, this is how I'm going to structure the deal moving forward. So that just takes that off the table automatically. You know, for me, when new investors are coming in, looking at the financials and looking at how much the Class A member, which is me, got paid or is getting paid versus investor distributions that were made.
That makes sense. Thank you. Appreciate it.
Right.
You're welcome. Absolutely.
So, Fuquan, I have another question. So, do you do all of your investing through your funds, or do you, let's say, I know you're still doing like some flips and things like that, or do you do some of them outside of your funds that, you know, would just be your own personal, you know, investments and things like that?
Well, absolutely. So I do have JV partners that I do stuff with, but our fund is, you know, is our first and foremost.
Primary.
Whatever doesn't fit into the buy box of our fund, then I would do a JV deal. So, you know, that's determined on, right now, my fund is set up for rentals. We buy rentals and we do flips. Mm-hmm. So if right now we're divesting a lot of the smaller rentals that we have, the 3 families, the 4 families, the 6 families, and we're targeting larger rental units because we believe that a lot of people are exiting that space now because of COVID. They're not collecting rents. They're not able to keep up with the payments. So they're exiting to get liquidity and to save face with a lot of the banks they have loans with. And we're buying that stuff at a discount. So we're looking at bigger deals as far as rentals. So what if I do get a rental that's a smaller deal, I'll do a JV with somebody that's not accredited and pretty much go for that. But we usually start with people who have at least $250,000 in capital or more to kind of do JV deals. It's not worth doing something with somebody who have 25,000, even though that's money. It's just from scaling perspective. It's, again, I want to manage money, not people.
Right.
So, you know.
Right. So that's actually a good segue into my next question is, so how has COVID affected not only your fix and flip business? I know, I already know the answer to that, but even more so, how has it affected, I guess, your note purchases and things like that for your fund?
Yeah, that's a good question. I've been through 2 downturns, 9/11 and 2008. And in 2019, in December, we launched this hybrid fund. And we actually trademarked diversified hybrid real estate investing. And in the fund, we buy tax liens. That's in our business plan, that we're allowed to buy tax liens, and that allow us to get real estate at a discount. We just attend a tax lien auction. Is it two strategies that we can do there? We can buy the lien and they'll redeem and we'll make 16% of our money. Or if they don't redeem, we can foreclose and take the property, fix it, flip it, or rent it. So that's one of the strategies we have in our fund, is tax liens. And then also we'll go to sheriff sales, or we'll buy REOs from banks, or we'll buy stuff direct to seller or off the MLS if we can find a big discount, and we'll fix it to flip it or rent it. Then we also have the notes, which I explained. We'll buy seconds, performing, non-performing, and stuff like that. So having that diverse strategy, we're able to, you know, turn a lever whichever way we want to go. It's a buffer, a hedge against any market upset. So the Black Swan event was at when we created the fund. The Black Swan event occurred Q1, somewhere close to Q2 actually of 2020. And 85% of our rentals, I invest in the C-class areas. I'm from North New Jersey, so I like going back into the community where I'm from and take those blighted properties and put them back on the tax roll, give the residents a better place to live. A lot of investors are afraid to go into those areas in the hood, as they call it. I love being on the front line of those areas, making a difference. So a lot of our units are subsidized rent with battered women and children in Section 8. So we had to guarantee payments from Section 8 in those programs, and that's 85% of our portfolio, and that's kind of what carried us through. Right. We did have some hiccups in payments and some delinquencies on our performers, but we jumped on the front line. Our services did a lot of bar outreach where we was able to delay deferred payments for 60 days if they agreed to make the next payment, so they got unemployment. So we were able to turn that around and decrease those delinquency rates very quickly, and we're still doing outreach and continuing to work with these people. And that's one of the things I like about the note space. So you have the power to give the homeowner a reprieve. You can set the payment for somebody who is a seasonal employee, like a landscaper. It could be $500 for this 7 months, and it could go down to $300 for the rest of the year. So you could be flexible to keep that payment performing. So a lot of the stuff we do are creative to keep those payments performing. So that's pretty much how we benefited. And we were able to still, at the end of 2020, generate a 10% net profit fund level return. After all our investments were paid, after all expenses we paid, we still made a 10% return. So
awesome, good deal. All right, so I don't think anybody has any more questions, but thank you. This was great information, and let me do this. Let me put Fuquan's contact information back up on the screen, so that if any of my viewers were interested in contacting him or interested in his note fund, the NNG Capital Fund, please feel free to reach out to him there. Take a look at his website. And Fuquan, I just want to thank you again for taking the time to chat with us and answer some of our questions and tell us about your fund. I appreciate it.
Also, I appreciate it. I do have an investor relations department. I see you have my cellular phone number here on Facebook. Back in the call. So I usually don't answer unknown calls. So if you get sent
who does?
unknown calls. So but we do have a number is 973-855-4922. That's 973-855-4922. Or just email me. I do respond to my emails. That's really the best part of communicating. You can catch me on YouTube or any other social media channels. You can just put my name into the search box. You'll see some of the renovations and stuff we've done. And if you're interested about investing in a fund, you can actually go to our website, NNGcapitalfund.com, and schedule a call. Again, we only raise capital from accredited investors, so you must meet that criteria in order to invest into our fund. Right. Thank you for having me on the show. I appreciate it.
Thank you. I really appreciate you taking the time. I know you're a busy guy, so thanks, and enjoy your mastermind. Thanks for joining us, everybody.
Have a great day, guys.
Great. Bye-bye.